This is my fourth year here, and every time it just gets better and better and better. So maybe just a hand for Chris and team. Like, this event is amazing. The pamphlets, it's like a nice texture. You know, I can't stop touching it. Just every last detail is just incredible. Where's the clicker here? How do I use this? Okay, so my name is Max. I work for Peak Hill Capital. We do a lot of bridge and CMHC lending. For the 10 minutes here, I'll just talk about the CMHC side, so that's CMHC construction and term lending. And when I spoke for the first time 4 years ago, I think that was the first time we had this event, it was really just like, what is MLI Select? And then over the years, we've progressed to, oh, this is the type of deals you could do, or how the performer works. But for this, I'm taking the angle that you guys are already aware of what MLI Select is and how that works. And I'm just going to talk about the trends and what we've learned over the years and where things are going here. So over here is just a sample distributions plotted on the map of where the deals that we've worked on. Just mine over the last 18 months. It looks like it's kind of all over the place, but over here we kind of have a distribution. So I'm sure a lot of you guys know where it's happening in Toronto, but of course in the York, Eglinton West area, it's all happening on the transit corridors, or the majority at least. So you have in that area, in East York, Danforth, and you have lower priced single family homes where the metrics make sense. It's easier to take down a property and put up a fiveplex. And as transit becomes more abundant in that area, you'll get elevated rents. And I hadn't spent a lot of time previously in East York, Danforth area. Amazing area, great neighborhoods. I've really come to enjoy going there, and they're getting some good rents there as well. At Tobico Humber, we're also seeing some deals there. Big lots, reasonably priced. People love to live there. Easy to get into downtown if you're working, especially if you have a car. And then a new, I guess recently over the past 6 to 12 months, we're seeing more deals in the North York area. Those are bigger lots, a little bit higher price, where people are looking to do bigger projects. More square footage, potentially severance plays. But overall, the theme is you got the transit corridors, and that's what's really carrying here. This kind of builds on what Matt was talking about, but the biggest thing with CMHC, and we get calls all the time, say, hey, I heard I can get 100% loan to cost. Is it possible without any other context? And I'm like, well, yeah, but there's a bunch of things that go into that. And the biggest one, to Matt's point, in addition to land, is your hard costs. So a lot of people, they talk about huge ranges, but really, like, the bottom that we've seen, this is also consistent with what Matt was saying, is $225 a foot. And of course, if you can build for that cheap, you can get almost 100% of cost. But of course, that you're not paying yourself. You don't have a GC. You can aim to get there, but it's probably hard to do that if it's your first project, and if you're not enlisting the services of somebody else. And of course, as you pay more, your loan to cost goes down. That's just the math. But this was assuming like $3.25 a foot in rents, or something like a 6,500 square foot building, and those are kind of how the numbers would shake out. So for MLI Select, a lot of changes happening over the last few years. I'm not really going to get into it or the rumors. You might see a little bit of pullback for MLI Select over the next month or two. They make changes every single summer, so you always have to be prepared that that's happening. I think Jaden was up here, already mentioned that the energy requirements are increasing by September 30th. But in general, what we always like to mention to our clients when submitting new applications, especially in a market where you have declining rents, is you need to have a good appraisal. So we always get appraisals in draft form. We comb through it. The appraisals, sometimes the comps are old and they don't always make sense. So you have to make sure that your application that you're putting forward actually makes sense. You're getting rent comparables in the immediate neighborhood, because you're trying the same way. If you're dealing with Foremost, trying to get a deal, telling a story, we're also selling you and telling a story to CMHC about why your rents actually exist in that area. Why should they underwrite your rents? If you don't do a good job, they will cut you back. So it's not like you can't take for granted that you get an appraisal and you throw it in. Now more than ever, because we're seeing, rents decline, and some clients, time to time do some shady things with leases. You have to have strong and demonstrate that you have good rents in the immediate neighborhood. And it's a negotiation, because you don't want to start going back and forth with CMHC and get sent to their own internal appraisal services team. Once you're there, you're already kind of losing, because they're going to cut you back. For CMHC construction, we didn't always do that. Now we're doing a little bit more of it. Some guys and groups would go private and then construction takeout. Now CMHC construction is becoming a little bit more prevalent. They're being a little bit difficult about demolition of your property. So if it's a single family home, when you apply to CMHC, they want to see that demolition is underway. That doesn't always work given how building permits work and your demolition permit works. And you want to get your application in and approved before you have the building permit. But right now we're seeing a little bit of inconsistency with demolition getting files through, because they want to see it raised to the ground, even though that's not always possible. But it's something you're going to have to create a story around, is that it's underway. And then for takeout financing, if you're going private, say with Foremost, and you didn't go CMHC insured for construction, the best way to do it, I would say, to get the optimal loan is apply to say, hey, we are going to be fully leased at closing, because then CMHC will be a little bit easier to negotiate with, especially if you think that you're building a good product, you're going to get high rents. The rents might not be demonstrated in the immediate neighborhood, because that way CMHC is not going to look too closely. And if you're fully leased and you have leases, you don't necessarily have to apply with the leases. You can apply afterwards, but it makes everybody calmer about the process to know that you're going to be leased at closing, especially with rents declining. That whole EGI not met, meaning not being fully stabilized prior to funding, is becoming a little bit less prevalent. But overall, 2026, like, CMHC is still here to play. Like, we have the best funding program, and one of the best funding programs in the world. If you talk to anyone from other countries, they'll say you guys are crazy. And we probably agree. Like, CMHC is right now more aggressive than most lenders. Like, we'll get an application. The credit teams will be like, wow, I can't believe this was approved. And we're like, put it through. We got it approved. So you guys should be happy. Like, there's still a massive, especially in Toronto, these files are going through pretty well. They want to continue to see the volume. Sure, things will change, but honestly, it's changing on the margin. They're not huge changes. So it shouldn't impact your investment thesis in the long run anyways, because most people are building to hold and not to sell. Over the years, lessons learned. So now that, again, we've been here for 4 years, what have we learned? What's been the theme going on through CMHC and with lenders? So when we started doing 4+1s, we were talking a lot about staggered building permits and deferred development charges on title, and that was confusing everyone. I think we're through that. Everybody kind of understands. HST self-assessment, there were groups retaining foundation walls to optimize their projects, and now that was causing a lot of issues with the CRA, and that they actually don't want to waive the HST, where now you're coming with a big bill. So I had a few clients deal with that well, and the advice was, if the CRA is coming back to you and saying that you owe HST and you can't get the rebate, just be respectful, provide minimal information. Don't make a whole scene out of it. They don't like that. You don't have to make a clown out of them. Just provide what you need to, and you should be okay. Don't try and prove a point or rally the troops around protesting them. That's not what you do with the CRA. So that was a big thing that we've heard. And I think the rest here we covered. Interest rate outlook, people love this. I'm out of time, but interest rate outlook, I would say, in speaking with our trading desk, interest rates are driven by commodity prices. So obviously with what's happening in the Middle East, that's elevated our bond yields. The AI surge, apparently also that's elevating bond yields because there's increased energy just across the board, whether it's oil or a shortage you see in the U.S. We have a shortage of energy. The power grid is not enough. All that stuff is putting pressure on interest rates. If that calms down, maybe we'll see a little bit of decline, but there's nothing in the near term that say it's going to go back. Bond yields are going to go back down 0.5% to where they were 2-3 months ago. So I wouldn't bank on that. Anything we're seeing in the future with CMHC, because we see a lot of deal flow. More of these severance plays, people building triple fourplexes or on these small lots, they're trying to build 10, 15, 20 units, more creative, taking longer to go through the city and take more risk. That's great. We love to see it, and it's working. Rents and location. So location is still the biggest thing. Location with real estate. And then cost discipline matters most, like I alluded to with the hard cost per foot. So try and control that as best you can. We're seeing that costs are coming down a lot, and guys are taking advantage. That's all for me. Thanks again, Chris.